just want to go ahead and give you an update on the markets, on the economy, on my forecast, and then what I'm doing to protect your portfolios. So with that, I'm going to go ahead and jump right in because you already know there's a lot going on in the markets right now. It's really volatile. We've had a lot of volatility over the last few months, and the markets overall are down since January. Nothing new there. But what I want to do today is explain why that's happened and where I see this going, and like I said, what we can do about that. So jumping in, first off is the economy. There are two big things you probably already know about, and the first thing is inflation. If you're like me, Olivia and I go out to get dinner, I notice it. Food's more expensive. Gas, I'm paying $5.50 for a gallon of diesel right now, and everything's getting more expensive. Next up is rising interest rates, and I'm going to go more into that here in a minute, but the Fed is raising interest rates to try to fight inflation. That's the short answer. So let's talk about why inflation is happening. One reason, and one of the biggest reasons, is we're still not out of COVID yet. Not getting into any of the politics around it, but China is still under a zero COVID policy. That means that if they have one COVID case, they shut down an entire city. Shanghai has been shut down, one of the biggest cities in the entire country. And we have so many follow-on effects from that because when they shut down, 6 months later, the goods that they would have shipped over here still aren't here. So when you're looking, and I made a video about this in the past, typically inflation is caused by demand side issues. That's because we make more money, we want to spend more, that drives up the cost of goods. Right now we have supply side issues because we just have the same amount of demand, maybe a little more, but we don't have enough goods to sell. So that means that sellers can increase the price of their goods to match that demand. So China's zero COVID policy is causing inflation. Also, Russia's war in Ukraine is causing inflation for a variety of factors. One is just the geopolitical implications, because we're all afraid that it will turn into a larger scale war. Obviously, it's been really bad, it's been really ugly, but it has been pretty much restricted to Russia and Ukraine. It hasn't spread into Eastern Europe. Other than supplying weapons, we're not really involved, and that's a good thing. I don't want us to be involved. But there are some follow-on effects here. And one of the biggest things goes back to food inflation. You might already know this, but Russia produces the majority of the world's phosphate fertilizers. They produce a ton of nitrogen-based fertilizers as well. All these things are necessary for us to grow the food that we eat. So since we have sanctions on Russia, either they're not shipping or the prices are way higher. And so there's actually a real fertilizer shortage right now across the world. That's going to be a really big deal for countries like Brazil, like the US, and especially other net importers of food, like those in the third world. Additionally, Ukraine is considered the breadbasket of Eastern Europe. So they produce a ton of wheat. Countries like Egypt and others import a lot of their food from Ukraine. Since Ukraine's at war right now, and there are bombs and shells going off, it's going to be way harder to actually get the spring crop in. So that's going to also hurt, not only now, but in the fall when people are expecting that food to come in, it's going to be a problem because it's just not going to be there. So this is the economy. Basically, we're trying to control inflation by increasing interest rates. I hope that works. It's kind of like using a hammer to drive a screw. It can work, but it's not the most efficient, it's not the most elegant thing. It's not the right tool for the job, but frankly, the Fed doesn't have the right tools for the job. And in just a second, I'll go ahead and show you what's going on in the markets. So now let's get into the market. The market, as I mentioned, it's not been great this year at all. And what I'm going to show you here in a second is that there's been no place to hide. Typically, we own stocks and we own bonds because they're not really highly correlated. Typically, when stocks go up, bonds go down, and vice versa. So you own stocks with the bonds as a hedge for your safer money. This year just hasn't held true for that. The S&P 500, it's a broad index. That's typically what people think of when they think of the market. It's down 16.25%. When you look at the NASDAQ The NASDAQ is made up of your tech companies, your high growth companies. It's down almost 26%. And then finally, the aggregate bond index, which is, again, where you look at for your safer money, it's down almost 10%. It's been really rough. There's nowhere there to hide. The one bright spot, and this is something I alluded to a month and a half ago whenever I was sent out my last forecast, is that value stocks have been down significantly less than anything else. So while the S&P 500 growth index has been down 25%, the S&P value index is down 6 to 7. Still down, don't get me wrong, but it has been a bright spot. And that goes back to interest rates, because everything goes back to interest rates. When interest rates rise, indexes like the tech-heavy NASDAQ and the S&P 500 growth index get hit harder. Had a video about that. I won't get into that too much, but it's just because of your basically interest rates for the time value of money. That's what it comes down to. $1 in the future is worth less than $1 today. As you increase interest rates, you have better options for your money, and so we actually discount the value of that NASDAQ tech-heavy high-growth stocks. So you're probably wondering, what's the forecast? Let me go ahead and clear the board and I'll be right back. So what are my expectations? My biggest expectation is that this isn't over yet. And frankly, the end is not in sight. I would expect that we're going to have more downturns in the market until we have a decent amount more pain. And why is that? It's because up until the last month or so, the market hasn't priced in the geopolitical and inflation rate risks that we've been seeing all along. I've been talking about this for a few months now. The chances of a hard impact, of a hard landing by the US economy, it's real. I don't think that we're going to get into recession territory, but it's a possibility. I'd say it's about a 33-35% chance. And so when I'm looking at that, I'm thinking, we have had a pullback, but there's still more potential pain out there. So that said, what are we going to do about it? First thing, don't panic. You've been here before. We've all been through this before. Recessions happen, pullbacks happen, bear markets happen all the time. That's one of the reasons why we get paid more to own stocks than to keep money in a savings account. It's not fun. Nobody likes to go through it, but you've been through it before. So just remember that. Next up, on the equity side, if you have non-qualified money, I just mean anything that's not in a retirement account, you're going to see some trading over the next few weeks. As the market continues to pull back, I'm going to be doing some more tax loss harvesting. I did this back in February during the last pullback. I'm going to do it again now. The reason why is I want to make sure that you take advantage as much as you can of the tax opportunities that this gives you. It doesn't change your long-term returns, but it gives you tax benefits. So that's going to be happening. Next up, I'm going to continue to move from growth stocks to value stocks. I started this a few months ago, and now I want to continue doing more of it because I think the next year and a half is going to be a great time to be in value stocks instead of growth. Finally, let's talk fixed income. This is a place where we can really reduce risk. The yield curve has steepened, and there's actually some yield in bonds these days. But we don't want to take too much yield, too much risk based on that yield. So some of you will be going into treasuries, short-term treasuries. They're a low yield, but they're a very, very safe place to be. I'm also going to be laddering that out from 2 to 5 years for some of you. For some of you, if you're in a great position, I'm looking over every single account. If you're a long-term investor, if you still have another 30 years before retirement, you might not see too many changes because you're still in a good position. So again, for that short-term money though, for the short-term bucket that we talked about, that's going to go ultra conservative into short-term bonds. Some of you are also going to see ladders. You might see a bullet share ladder in your portfolio, and that is to reduce your interest rate risk. I want to make sure that instead of buying longer-term bonds, that if interest rates go up, they're going to get knocked down even more. I want to make sure that you're protected against that. So I'm going to ladder those bonds 1 to 5 years out, so that as they mature, we can reinvest that money at a higher interest rate. That's the plan there. So again, one more thing, don't panic, because it's okay. I've been through this before. You've been through this before. It's not a time to worry. This is why we get paid extra, again, to own stocks and to take a little more risk, and it's gonna be okay.